Good morning. You might want to increase my volume. Hey there. Thanks so much for doing this. Good to see you. The presentation looks great. I love the building block. 501c3, I'm thinking of the audience, but no, perfect. Yeah. Good morning. Let's make our way to our tables. We're going to get started. "30 seconds. Good morning. We're going to get started. Make your way to your tables, please. Well, good morning. Welcome to the December 6th meeting of the North County Estate Planning Council, San Diego. Thrilled to have you. Happy holidays. Obviously, we've got a great turnout. I think hopefully we're getting back to normal. We look forward to taking the whole room in upcoming meetings. But great presentation today with Jenny Bratt and Helen Cheng of Withers Bergman. They're going to be discussing everything an estate planner should know about charitable planning. Certainly, we encourage everybody to come in person. As you see from the group, and as we've been experiencing over the last year, it's like old home week to see everybody back together. Certainly, do invite your clients as well as your colleagues or other folks that you work with in the estate planning world. Many of our talks are appropriate for clients, so safe place, so be sure to invite them. I want to bring up our sponsors for today's meeting, Northern Trust with Barry Levine and Elaine Becerra. It's all yours.
Good morning, everyone. I'm Elaine Becerra. Happy holidays. It's wonderful to see everyone here today. Several people that came in this morning shared that, like me, this is our first meeting back in person. So I'm very happy to be here in person today. I'm a senior wealth strategist with Northern Trust Wealth Management. And today I'm joined by my colleagues and partners, Barry Levine, which is our wealth advisor, senior wealth advisor. I also have Bill Guthrie, which is our senior fiduciary officer, and Eunice Brogaias, our trust advisor. As a market leader in wealth management services for high net worth individuals and families, Northern Trust offers integrated wealth management strategies, including investment management, financial planning, private banking, fiduciary services, business and philanthropy advisory, and family office services. Northern serves 25% of the Forbes 400 wealthiest Americans, drawing from more than 130 years of experience advising wealthy families. Our experience advising generations of clients and our dedicated research center, the Northern Trust Institute, ensure we bring proven strategies that are optimal for every client situation. There is no wealth management challenge we have not seen and solved time and time again. And speaking of the Northern Trust Institute, I would like to invite everyone to save the date for the 2023 Northern Trust Institute Wealth Planning Symposium on April 27th. Join leading industry experts to gain insight on cutting-edge strategies to support your practice as affluent clients challenge the greater meaning of wealth. So this is a full day of presentations that we will be hosting live in Chicago, but we have thousands of people join virtually as well for many C credits. And also Bill joined last year and he was extremely impressed. So we'll make sure to share more information with everyone later. And with that, I would like to bring Barry.
Thank you, Elaine. One announcement I'll make just to elaborate. Some of you know Brian McDermott, who is longtime chief fiduciary for Northern locally. Brian retired, so Bill, we not fully mentioned, is now chief fiduciary officer of Northern. So long time coming. Thank you, Bill. So I want to give a little brief summary of Northern. Most of you know who Northern Trust is, and I was going to look at the slides, and I'm noticing my older eyes are not focusing super well this morning. So bottom line is Northern Trust started the late 1800s in Chicago, basically a wealth management firm. Started out, the roots were basically a multifamily office for a lot of wealthy Chicago families, the Donnellys, the Wrigleys, Smith family who started Northern Trust, who've connected to Illinois Tool Works. And to this day, those roots reflected in what we do these days. And so I want to focus on a few slides here. So if you go ahead. So for those of you who do not know Northern, have a range of services: wealth planning and advisory, which I represent, trust and estate services, investment management, and banking. And going ahead a slide, what I really want to focus on today is how we work with business owners and asset owners, given the fact that so much of what we do as part of the Estate Planning Council is related to business owners. So quick comments on the left we have lent about $1.8 billion to multiple businesses. Many people do not know, we manage over 1,000 real estate properties. We have a separate oil and gas group out of Texas. So one of our specialties is managing illiquid assets. And always a little suspicious of company lore. So my caveat is I'm told we're about the only major national trust company that does all this in-house, as opposed to sending it out, contracting outside. So what I want to focus on is two areas of Northern, going ahead a bit. So next slide, which is we have two distinct groups. One is family business group, which what happens a lot of times, you can imagine, is people haven't fully done their planning. And it ends up being, we have a family business they want to keep in the family and no one to run it. And so punchline is Northern ends up serves as trustee for something like 1,100 operating companies throughout the country. The best example, going ahead a moment, was actually when I joined Northern. One slide. Excellent. You're hired. One more. Oh. Can you go back one? Head two. Yep. And you've got, so one of the first companies we dealt with, at least when I joined Northern, was a gaming company that you know out of Nevada, that Northern came in, basically ran the company, kept the management in place, prepared the business for sale, ultimately sold the business for a few $100 million, actually close to $1 billion. Now, the fascinating thing was, having worked with the heir, the family paid somewhere in excess of $300 million in estate tax. And to this day, no one knows, was that the family's intent or was a lack of planning? So again, so one aspect with business owners is the group managing businesses. The second part, going ahead a couple slides, is our business advisory services group. Keep going. Okay, thank you. So I'm told that Northern is one of the largest wealth management firms that does not do investment banking. On the other hand, we have a lot of clients, business owners, who could use assistance. So about 5 to 7 years ago, Northern added a group, our Business Advisory Services Group, which is a group of ex-investment bankers who now work for Northern, counseling business owner clients on perspective from the other side of the table of what is it like preparing a business for sale, et cetera. So we have more details in the handouts that you have, and what was the PDF that was sent out to those online. So I just want to go through very quickly. So next slide is one more. is saying, so us being Northern, we're going to start looking at, are you prepared for sale, both financially and emotionally? You know, we find so many families, the business is like another baby in the family. And as Bill knows, so many times the business owner emotionally is not prepared. What does life look like afterwards? So as you would expect, doing a lot of upfront counseling in terms of how do we prepare the business for sale? How do we prepare the family for the sale? And what's the next chapter for the business owner? And we go through a few steps. So on the next slide, phase one is typically helping families choose an investment banker. And then on the next slide is deal oversight, and I'm laid out here, investment bank's role versus the Northern role. And what our clients we find are finding helpful is the Northern's third party, they're not the investment bank, so they're not involved in the deal. But having done this on the other side, give lots of good perspective. Best example I have is a client now where it shows a investment bank and through Northern negotiated the fees down by $1 million, but between $1 and $2 million. Came up saying, let's have a dog and pony show in terms of let's see who else is out there for investment bankers. Came down to 2 and basically said, okay, you got your 2 finalists. What's your best offer? Went around a couple times and got the investment banking fees again down by $1 to $2 million. If Northern wasn't there, not sure it would have happened. Given the standalone fees we charged, rate of return was probably about 5-6 times what they paid. So given time constraints, I'm going to turn over to Bill. But again, happy to be here and happy holidays.
Thanks so much, Barry and Elaine. Really appreciate the sponsorship and great information that I know of. Certainly do put the Northern Trust Symposium on your calendars. You can be assured Paul Lee will be part of that presentation. And an interesting presentation last year was the presentation by Eric something, whatever, gobbledygook, but he's in the family business advisory group, but they analyzed the movie The House of Gucci and looking at all of the myriad of problems and challenges within a family business. And there were plenty in that movie, if you remember. So thanks so very much, and we'll pass on the information for registration later. Certainly want to thank and acknowledge First American Trust, who has provided information for their Canon Financial Institute Estate Planning Series. The next one being December 13th. This is for our members, and I'll be sending out the registration information shortly. They're going to be covering assorted ethics-based and related legal conundrums for estate planning professionals. Our next meeting is January 3rd, right here with Mark Morris, JD and CPA of Levitt Zach CPAs, who will present on ACE of Basis, stepping up to sophisticated planning idea, plus what's hot and not for 2023. Mark is a very sophisticated and cutting edge estate planner, and really his presentation shouldn't be missed. Upcoming meetings after January, we've got February 7th, which is kind of a state of the real estate economy with Doug Wilson of Douglas Wilson Companies, Nathan Motor of London Motor Advisors, and Brett Albrecht of Kramer Land Company. And you have 2 experts in kind of the economic side of the real estate world, as well as someone that's inside a family real estate business, and it's taking advantage and learning and molding their real estate portfolio as we move through this kind of crazy economy we're in. March 7th, we've got Dawn Hall-Canine, who's going to head up what the estate planners could learn from the estate administrators and litigators series. And April 4th, we're resurrecting our business exit planning series. We'll have more information on that shortly. And then in May 2nd, we've got Steve Akers of Bessemer Trust, famous for his musings from Heckerling. And he's going to be presenting on current thoughts on estate and charitable planning. Just a heads up, the Advisors in Philanthropy has a networking event in January, and we'll have more information come out in email directly to you. Certainly go to our website. David Jacobs has done a bang up job with that. Is Pete Tentler here? Could you grab a bowl so people can deal with the trifectas, which is Pete, of course, master networker, will take everybody's card that goes in the bowl that David's grabbing and connect you up with 3 or 4 other people that are not in the same industry for a coffee, breakfast, lunch, what have you, for a deeper relationship building opportunity. Certainly want to recognize our good friends, Jewish Community Foundation, who really stepped up and helped us during the whole COVID time frame as far as sponsoring and managing our Zoom presentations. And without any further ado, I'm going to have Elaine Becerra introduce our speakers, Jenny Bratt and Helen Cheng.
Thanks, Bill. So both Jenny Bratt and Helen Cheng are with Withers Worldwide, which is a global law firm advising some of the wealthiest clients in the world. Jenny Bratt, I'm going to read a couple paragraphs from her bio, but it's very extensive and you guys all have a copy of it. So please make sure to finish reading because it's pretty impressive. Jenny is a partner in the private client and tax team at the international law firm Withers Worldwide. Her practice is focused on U.S. and international estate and income tax planning, trust and estates administration, family and closely held business planning, and charitable planning and exempt organizations. She advises U.S. individuals who own foreign assets on the manner in which such assets should be structured, as well as their U.S. tax compliance obligations. She routinely employs transfer tax mitigation techniques, such as intentionally defective grantor trusts, grantor retained annuity trusts, irrevocable life insurance trusts, and family limited partnerships, among others. She's also a member of ACTAC. And next we have Helen Cheng, one of my favorite people. Both of them are. Helen is a partner in the private client and tax team at the international law firm Withers Worldwide. She is a trust and estates attorney who focuses on exempt organizations and international tax planning for inbound and outbound transactions. She assists clients in all aspects of estate planning, estate and trust administration, and charitable planning. Helen brings a diversity of experience to her clients. After graduating from Stanford Law School, she practiced international corporate law in China and California, where she worked with multinational corporations such as Oracle, Intel, and Seagate on sophisticated international tax planning techniques. Helen is also certified as a specialist in estate planning, trust, and probate law by the State Bar of California Board of Legal Specialization. That's it. Thank you. No further ado. Let's bring Helen and Jen.
You know what, can I move this podium back so I want to be able to see it? Oh, all right, there we go. I can see our friends in the corner. Hi, everyone. Thank you so much for having us. I'm Jenny Hill Bratt. This is Helen. I want to thank our colleagues that are here today. We also have Allison Whitmore from Withers, Sarah Pike from Withers, and Austin Pruitt, who, Austin, raise your hand. I'm going to embarrass you. He is our newly admitted attorney. He just passed the bar, and we're so proud of him and so happy to have him here. So congratulations, Austin. Helen and I want this presentation to be as dynamic as possible. We have so much material to cover and we probably won't get through it all. Our goal is that this is sort of a primer on charitable planning, but through the presentation, we're going to go into some deep dives and some case studies with interesting examples that Helen and I have had the pleasure of working on together.
Oh, can you hear me? I've said so many interesting examples. And of course, we want this to be interactive. So Jenny and I will chat, but if you guys have questions, comments, interesting stories, please share.
And it's worth noting, I think Elaine did a nice job giving a little background on Helen. When Helen joined with what is now Withers, her focus was international estate planning. And then she started to develop a love for charitable planning. And a couple of years ago, she merged the two together. And Helen is truly now one of not only the nation, but a world leader in international charitable planning, which is a super interesting nuance, and the issues come up more than you think. So Helen is truly my go-to person with these tricky charitable questions. And so I'm really excited to co-present with
Oh
her
my
today.
gosh, Jenny is so kind. She
All right.
is, of course, one of the best domestic planners in the nation. So
All right, and XOXO. All right, so let's go to what is a
and
charity?
she has the cutest kids
Oh,
in the world.
Helen's kids are cute too. Cute. So what is a charity? So charities, this is just a little primer. Charities, as I think everyone knows, are tax exempt organizations. We typically think of the core of charities, which are 501c3s, but there's all other types of tax exempt organizations under the code that come up from time to time with our clients. And sometimes there's an interplay between the two of them. So Helen, do you want to talk about?
Yeah, absolutely. Well, it's interesting. And the reason that we put this slide up is because, we work with philanthropic individuals, but we also counsel exempt organizations. So we work with a number of charitable organizations here in the US. And interestingly, I had a conversation with someone who's worked at a charitable organization for many, many years. And she said, Helen, I'm confused. What's the difference between a nonprofit and a tax exempt? That's the same thing, right? And actually the answer is no. We use them interchangeably, but the term nonprofit, and so we thought, well, this will be useful for everyone so we can all be on the same page and you can feel very, very smart when you correct others and do it with a smirk. So a nonprofit organization is a type of organization that is created under state law, right? So you create a California Public Benefit Corporation. These are under their charter organizations that are irrevocably dedicated to charitable purposes. A nonprofit organization, let's say you create one in California, often now we create them in Delaware because there's some more flexibility there. Those in of themselves are nonprofit entities, but they are not tax exempt. So you have a nonprofit, you create it, and let's say we create the Cheng Family Foundation. It's a California Public Benefit Corporation. It's irrevocably dedicated to charitable purposes. However, I cannot start going out to solicit donations and I can't say, hey, give to me. I am a nonprofit. So now you can deduct. The next step you have to do is, although I am a nonprofit, I still have to apply to the IRS for tax exempt status. And so you can apply for tax exempt status in a number, based on a number of different code sections. So some of you might have heard about some large gifting from Patagonia. That was actually to a 501c4. They also have 501c7s, 501c6s, they're social welfare organizations, trade organizations, et cetera. And each one of those 501cs, there's about, I think like 17, there's like a cemetery association. I mean, they're like really quirky ones, but each one of them has tax exemption under a different 501c of the code. Within that, so you can apply for tax exemption in a number of ways. Each of them has different characteristics. 501c3 is the one that almost all of us think of when we talk about tax exemption. It is a particular type of exemption for public charities, for private foundations, for entities that you're used to dealing with, the American Heart Association, San Diego Rescue Mission. All of these are 501c3s, and they're the ones that we really know and love. So when someone talks with you about a tax exempt organization or a nonprofit, chances are they're talking about a 501c3. But you should always know that there might be some difference there.
So now we're going to talk about the different classifications under 501c3. And we're going to turn to our first case study. So it is not uncommon for our clients to come to us and say, I've had a liquidity event. I need to generate a charitable deduction. I've sold a business. I need to generate a charitable deduction, or I'm just at the point in my life where I want to give to charity and I want to create some sort of a 501c3. This chart, I think, is helpful because it kind of walks clients through the different options for 501c3 entities that they can create. Here's a case study. Is a couple of years back, clients came to us and said, we want to create a charity. Actually, they didn't have a liquidity event. They were just super generous, nice people. And we want to create a charity. And so why don't you walk through, Helen, what the different questions we ask them?
Absolutely. So the first question that we ask someone, if we have a philanthropic donor, is, okay, well, first, what is your mission? What is your vision? Is there a charitable purpose? And then how is this going to be funded? And if you have a charity that is funded substantially by a small number of donors, then you would normally fall into the category of a private foundation. A public charity is a charity that is either what we call a per se organization, such as a school, a church, a hospital, or it's a charity that is funded at least a third by the general public. So the first question we ask is,
Who's going to fund? Now, in this particular case study, the clients were, I always get bearish and bullish. They were conservative. So that's bearish, bullish. Which one is it? Bearish. So they were bearish. They're a well-connected family, well-known in the Bay Area. And they thought, we have this great idea. We have this great vision, but we don't think any of our friends will share the vision. And we think it will just be funded by us. And so we went the direction of a private foundation.
That's right. And what normally happens is a donor will give significant amounts of money. So, maybe millions of dollars to fund their private foundation. So it's very hard to get, a third other assets that are funded from others.
So we go the direction of a private foundation. Then we have a decision point. Do we want to do a non-operating foundation or an operating foundation? So a non-operating foundation is, I think, what we typically think of when we think of a private family foundation. Transfer assets, you create a nonprofit, you get tax exempt status, assets go into the corporation, and then each year, 5% of the fair market value of the assets in the foundation need to be deployed out to 501c3s. Now, let's talk about operating foundations and why you would even want to do an operating foundation.
Yes, so an operating foundation is unlike the standard grant making organization or non-operating. Instead of having to give out 5% of your assets each year, you can give a smaller amount, about 3 1/3. And the reason that you can do that is because you're not just writing checks. You are operating. You are a charity that's activities are in the active conduct of its operations. So, for instance, if you are a charitable organization that wants to support medical research, a grant-making organization would write a check to the Scripps Institute and say, "Okay, congratulations, our work here is done, and we'll make more distributions next year." An operating foundation will actually create programs, maybe develop a lab and do the work themselves. So because it is much harder to spend, 5%, a percentage of your assets on actually doing the work, the IRS says, you know what, or, you know, the code says you don't have to spend as much. So, so there's these two different characteristics, and it's interesting. We'll get to why why many folks end up selecting operating foundation. You know, they want to be very much in the active conduct of their operations. We actually had one client who created a foundation. It must have been in 2020 or 2019.
Peru.
The Peru, yeah.
It's
2019, but they created it, and you know, they had a large liquidity event, and we said, okay, well, you know, we'll do a private foundation because, right, it's a small donor size, they have a large donation, and you know, we were interested in helping them receive a larger or more favorable income tax deduction. So an operating foundation has, so a public charity has advantageous tax deduction characteristics, which we'll talk about.
Going in, you get more of a tax deduction.
Yes. And specifically, if you gift an asset other than cash or public securities, a gift to a private foundation, non-operating, is limited to basis. So, you know, let's say you have a company that you've created and you want to, you know, give it to charity. A private non-operating foundation is not a good tax beneficiary because your deduction is limited to basis. Whereas a gift to a public charity, you get fair market value, and an operating foundation gives you that same benefit. So back in the day, we said, okay, well, friends, if you would like to create a private foundation, you should do it as an operating foundation. And they said, great. And, you know, we thought that was the end of it. It was like, okay, you have to make sure to do some activities, okay? And it has been amazing because since then, you know, they have actually developed amazing programs. They're developing a huge partnership internationally with nonprofit organizations, and they're actually now creating an entity in, you know, in their local culture, in a different country, to be able to continue to do their work. So again, an operating foundation, you know, we often advise for it because of the great tax advantages, but you know, it's also a wonderful thing to you know, for the donors to be able to operate.
So in this in one example, we had clients that absolutely said, we don't want to just be grant making. We don't want to just be writing checks. We actually want to be doing the work. And the operating foundation also had the benefit of offering an optimal income tax deduction for them. Another cool characteristic, in addition with an operating foundation, in addition to the charitable deduction, is it's relatively easy to pivot from an operating foundation to a non-operating foundation. So when I'm talking to clients about setting up a private foundation, if there's any chance, or if they think that they are going to be doing good work, be actually doing the work, we will start with we'll start with operating to get optimal deductions. And then if a couple of years go by and they go, this actually isn't that great, I'd rather just write checks, we can easily switch to non-operating. But it's much more difficult to go the opposite way, which takes us back to the case study that we talked about at the very beginning, where the clients were bearish and said, no one's going to give, we're just going to write checks. And lo and behold, a couple of years later, Helen, what happened?
They said, oh my gosh, our friends have given us so much money. We barely have funded, and it's 65% funded by non-us sources. Can we convert?
And the answer is yes, but. So going, if you kind of look at this chart, going up is easy, going down is difficult. So when the clients came to us and said, we actually want to go down, we actually want to now convert to a public charity, it's a heck of a lot of work. And when we explained that to the clients, they were like, what? Why didn't you advise us early at the beginning that it would be so much work? Luckily, and here's a little practice pointer, we had a really good documentation in our file. And we said, well, remember, you were bearish and you thought your friends wouldn't contribute, and actually turned out to be the opposite. So it is possible to go the other way, go down, but it's go down, but it's much easier to kind of claw back.
And Jenny, you're absolutely right. Going from a public charity to a private foundation, if you don't meet the public charity requirements, you automatically become a private foundation. And the IRS actually in their rules, they say, okay, so if you automatically become a private foundation, you don't have to notify us, just fill out the informational form that is the 990 PF for private foundation rather than the standard 990 for a public charity done. And same with an operating foundation. If you don't meet the operating foundation test, then you become a private grant making organization. Done, so easy. And that's all it is. But going the other direction is quite hard and you need to satisfy significant years of testing. So it is an issue.
So this next slide is helpful, and it kind of circles back to what we were talking about on the last slide, which is depending on what type of organization you give to will determine the type of income tax deduction that you can receive. As well as what type of assets you want to transfer to the organization will help guide you with what kind of income tax deduction you will receive. So it's just helpful to, I like to actually have this in front of me when I'm meeting with clients who are interested in charitable planning to kind of walk through their options and the various considerations depending on what asset they plan to give to. We wouldn't be here if we didn't talk about gift and estate tax deduction. So this chart also goes through the code sections for the relevant deductions. What is, I think, very critical here, and sort of circling back to my comment about Helen's expertise in international charitable planning, is what a lot of clients are surprised to find out is that contributions to non-501c3, so an international organization or a non-US organization that is clearly doing charitable works, but if it's not a 501c3, you're not going to get your US income tax deduction. So I have a client right now, she's a US citizen, but she's a permanent resident of the Netherlands. And she is extremely interested in charitable giving, but she wants to give to organizations located in the Netherlands. And by giving to those organizations located in the Netherlands, she will get a Dutch income tax deduction. But she's also very motivated to get a US income tax deduction, because even though she's living in the Netherlands, making money in the Netherlands, because she's a US citizen, she has to pay worldwide income. So she is also needing to qualify and making her charitable contributions qualify for a US income tax deduction. And that it gets a little tricky, but there's actually organizations out there that can help facilitate that. In general, she can't just write a check to a Netherlands charitable organization in general. And I'll have Helen kind of talk through the nuances. The easiest way is for her to donate to an international organization. They're sometimes called friends of organizations that will allow her to qualify for the charitable deductions in both jurisdictions. But
yeah, you're absolutely right, Jenny. Whenever you have a client that is interested in making gifts abroad, and particularly if they are dual income tax, if they need to file or pay income tax in two countries, it's very country and jurisdiction specific. So if that happens, you're welcome to give Jenny or I a call and talk the question through. But they're very, very specific. And in fact, Withers in London created a type of charitable entity that's dual qualified in both the US and the UK, specifically because there was this very technical issue of how in the heck does, someone who pays tax in both countries get a deduction in both countries. So we actually came up with a structure in which you have a US corporation, it creates a UK charitable entity, the UK charitable entity makes a check the box election. Magical, and it's completely disregarded in the US, but it is regarded in the UK. So you make a contribution to that. It's deductible in the UK because it's a UK entity. It's deductible in the US because it is a flow through entity. Magic, you get a deduction in both countries. But it's very, very specific. Sometimes you have to look at treaties. Sometimes you use friends of organizations. It really depends. And again, it's very specific.
Yeah, that case where our colleagues in London kind of developed this structure, it was coming up with, you had a lot of US citizens, well, they were dual US, UK, but they were living in the UK and they really wanted to give to their university here in the US. And the UK said, well, that's nice, but you're not going to get a UK income tax deduction. And so this structure essentially facilitated that.
And just as a quick note, if you do have a client who wants to give abroad and you say, well, you're not going to get an income tax deduction, and they say, don't stop there, because there may be some other considerations, including gift tax or estate tax. The great thing is gift and estate tax rules, they're both slightly different than the income tax rules, but generally you aren't going to have to pay gift tax on a gift to a foreign charity, but you do want to make sure of that. And, you know, there was actually an interesting situation where we had a client who inherited hundreds of millions of dollars from her father. And she said, you know what, I actually want to give that to charity. But the charity was going to be a non-US charity. So we actually had to work with her. And we're like, okay, well, you can do this. You don't get an income tax deduction. Let's look at the rules and make sure you don't have to pay gift tax on, you know, hundreds of millions of dollars. So we were able to structure it and just make sure that, you know, you don't get an income tax deduction, but at least you don't have to pay tax on it. So, so there are ways to do it. You know, we can work with clients and you can work with clients who want, you know, the goal is that we want to support the clients in whatever they do, and you can do that. You just have to make sure they understand the rules and we don't pay hundreds of millions in gift tax.
Yeah. So to emphasize, like the client did not need a US income tax deduction, but there was a concern, and we had to do some structuring to avoid this concern, that by making a gift, which is a gift to a non-US organization, that wouldn't trigger a US gift tax. Like, what a bummer would that be?
So now we get to the fun stuff, which is you have a client who is interested in giving to charity. What are all of the options that you have? Well, let's see if we need to go. So let's go to the next slide. And the first and simplest way to give is always just giving directly, right? You can give a cash gift. You can give a gift of appreciated assets. Again, keeping in mind that if you're giving appreciated assets, you want to make sure that those appreciated assets are.
Oh, I messed up. I double clicked it. I
Yeah,
double directed it.
no problem.
Sorry.
Just go back one. Yeah.
Sorry.
So you can, as long as the gift of appreciated assets is, if the gift of appreciated assets is other than publicly traded securities, your only job is to make sure that they give to a public charity or private operating foundation. Other than that, it's very simple. You all know how it works, and you've all worked with clients who've done it. But another kind of gifting, and now you can go to the next slide, is gifting through a beneficiary designation. And I think we've all heard about this technique, and we'll talk about gifting through IRAs in more detail towards the end of this presentation, given the Secure Act. But generally, if you, as you know, an IRA is a really interesting beast when it comes to estate tax and income tax, right? So an IRA is included in your estate for estate tax purposes. But unlike most assets, an IRA does not receive a step up in basis, right? So we all know that when someone dies, almost all of their assets get a beautiful step up in basis. So let's say you have a testator who dies and she bought her house, back in the day for $100,000, and now it's worth $10 million. The wonderful thing is, it's very sad that she passes, but it's very great from a tax perspective, because now the basis is $10 million. And so then, the beneficiaries receive that, they sell it, they receive no gain. Everyone is very, very happy. They're sad that the person died, but other than that, but for an IRA, you have a different,
Depends on the
it depends. Some happy, some sad. It's very complicated. But with an IRA, you have, there are different rules. An IRA is included in your taxable estate. So, if you're over the exclusion amount, then you do have to pay estate tax on it. It goes to the beneficiaries. The beneficiaries say, yay, sad person died. I'm gonna, cash out my IRA. They still have to pay income tax. And so the most effective way, if your client wants to give to charity, have them do it through their IRA, right? Because you gift your IRA to charity, the charity, liquidates it, and no worries, because your charity is a tax exempt 501c3 organization. They don't have to pay tax on it. Everybody wins except for the government, but that's okay, because we'll support the government in other ways.
And I can't kind of emphasize this point enough. I think, in the past couple of years, clients will come to me and say, the law hasn't changed yet. The law hasn't changed it, right? Do we need to look at my estate plan? The law stayed the same. And it did with regard to the exemptions, but it did not with regard to the Secure Act. And so, retirement accounts used to be this amazing vehicle to transfer to non-spouse beneficiaries. I passed away, my retirement account, if my husband's dead too, goes to my kids. And then my kids used to get to stretch out that retirement account over their life expectancy. Now they have to pull it out in over 10 years, taking a chunk each year over that 10-year period. And so it's just kind of a bummer asset to inherit now, which really makes, I think, for all of us professionals in the room who have assets in their retirement accounts, like, sorry, kids. So it's kind of a bummer, but one of the, I think, sort of like low-hanging fruit, and as well as low-hanging fruit for helping our clients, as well as just sort of a meaningful tweak, is when you're looking through your clients' estate plans, if they have sort of specific charitable bequests in their estate plans, which isn't uncommon, 10,000 here, 20,000 there, and they also have a retirement account, to remove those specific bequests from the estate plan, and have those specific bequests made through a retirement account. I know it's been discussed here, but I kind of can't emphasize it enough. Clients also love it too, because they don't have to pay their attorney if they change their mind about what charity they favor. So obviously, if they've listed the ASPCA and then they want to change the charity to the American Heart Association, they have to pay us to amend their estate plan. If it's through the beneficiary designation on a retirement account, they just get to update the retirement account and don't have to pay attorney's fees. And so the way I kind of explain it to clients is, if you're giving 10,000 to a charity, it's going to come out of somewhere, and your kids, from a tax perspective, are way better off if that 10,000 comes from your retirement account, because unfortunately, that retirement account just isn't as great of an asset to inherit anymore.
You're absolutely right. And so the next two slides just sort of illustrate what that difference might be. If you have a non-taxable estate, the kids will save on the income tax side of things. And if you have a taxable estate, you actually get an estate tax deduction as well. So you save both on the estate tax and on the income tax side. But also, just to go to mindset switch with IRAs, we represent doctors who often, they have their own business, so they fund their IRA both as the employers and the employees. So they're saving, tens of thousands of dollars each year, significantly over the standard, 19,000. And I was counseling one recently. He has, about $3.5 million. And I said, well, you have some options. You may not want to save fully in there because I know that you plan on, giving this to your kids, and with your kids, it's not, they have to take everything out within 10 years. And he was like, what? That is breaking a cardinal rule, because all of us have always been brought up thinking, oh my gosh, we have to keep this as long as, we have to we have to increase our IRA to the largest amount we can. So that way, when we give it to our kids, they can keep it for as long as they can, and on and on. And that's just not the case. And, if you have, a $6 million IRA that has to be taken out over a 10-year period, boy, you're at the highest income tax bracket, and it may not be the most effective tool for giving. So we have just a couple of examples here for a taxable and non-taxable estate, so you can see sort of what the difference is. And then another gifting option is a bargain sale. Let's say you have a client who is very charitably inclined and has an asset that might have some appreciation and some gain. Your client doesn't have to give the whole thing to charity. Maybe they want to give some of it to charity and then sell the rest to charity. They don't have enough liquidity to be able to do full gifting. And we can, thank you. There you go. So essentially what the donor is doing is the donor is making a gift of the difference between the fair market value and the amount that they're gifting. And, often the most common time we see this is when someone has a house. They might be downsizing, moving to another location, and they say, okay, I want to gift to my favorite charity, and also receive an income tax deduction, but I can't give the whole thing. My house is appreciated a lot and I need some of those assets for myself. So this is where we would work with the charity. And, you have to work hand in hand. We have a lot of folks who work at some charities, and they would be happy to talk with your donor, but they have to also be on board, right?
And we've seen the bargain sale technique work very well when you have an elderly person who is charitably inclined and needs to move into a care facility. And as you know, it's like super expensive. You could put a big down payment, et cetera. But so they need some of the money from the sale of that house, but they don't need it all for whatever reason. And so the bargain sale technique, I've seen it work very nicely.
Absolutely. And we aren't going into it here, but when you have there are a number of techniques that you can use, and a bargain sale is one of them. And you can go to the next page to sort of show how the calculations would work. But oftentimes clients, you can pair a bargain sale with other techniques that allow for, for instance, instead of a bargain sale, you can gift a portion of your asset and sell it through a charitable gift annuity, et cetera. So some of these, the concepts that we're talking about can actually be mixed and matched and blended to create, a custom product for your client.
All right, we're going to move into split interest gifts. I know this is a concept that everyone here is familiar with. And so the technique of a split interest gift is it is a split interest, meaning the client or members of the client's family or people the client care about get some benefit, and then the charitable organization gets another benefit. What I always kind of warn clients against, well, not warn clients against, but warn clients about is depending on what type of asset they want to put into the structure. Oftentimes it can take us just as much time analyzing the asset and making sure it's an appropriate asset for us to transfer to a charitable structure as it is for us to actually draft the documents to create the structure. So cash is always easy. We can always do it with cash. Homes, easy, as long as there's no mortgage, we can figure it out, but no mortgage is easier. But once you start adding in more creative assets, there's some hoops that we have to jump through. But what I always like to tell clients is we'll figure out a solution. Let us know what you want. We'll figure out a solution, but sometimes it can be a bit tricky with the split interest gifts, but we'll walk you through some case studies. Yes.
You're absolutely right. A pooled income fund would be another option. It's similar to a charitable gift annuity.
I can do a quick poll, sorry. Salk Institute does have a pooled income fund, but I've been there 15 years and we're trying to get rid of them. So is there anybody here who's actively marketing or knows of any active pooled income funds? Because I'm not aware of them.
I think with interest rates where they are now, if you had one 2 years ago, it started with sort of a baby bill. they look at it.
Yeah, I'm just not aware. of
Beneficial, then in phase of it.
What we're seeing is reuse is a private pool income fund. So this is very specific pool income fund for one individual, so sort of oxymoron. But as far as the 1,500 pool income funds out there, I do see most trying to scramble to close it down, but it's just not a viable tool in the same way that it was 50 years ago.
Thanks, RJ, and thanks, Jenny and Helen for letting me take that.
No, please do. It's so much. Helen and I hear each other talk all the time, so we'd love to hear from you guys. So let's move to, yeah, we're on the slide, charitable gift annuity.
Yeah, absolutely. So a charitable gift annuity is, like I mentioned, it's sort of a variation on the bargain sale. Essentially, perfect. Instead of getting paid on the sale portion, you actually get the payout as a guaranteed annuity for the course of your lifetime. A charitable gift annuity is, it's very simple. And if your donor wants to use a charitable gift annuity, they can go straight to their favorite charity. And the charity should have one, or if the charity doesn't, they can find a service provider who can help create a charitable gift annuity for them. Charitable gift annuity is super, super simple. Just a contract, just a couple pages. It's like the opposite of some of the documents that we prepare. But essentially it says, we as the charity, we guarantee based on the full value of all the assets in our organization that we will pay you a fixed annuity for the rest of your life. And it's a very, very stable tool. And there are fixed rates that are often set by, charities often use the fixed rates as listed by the American Council on gift annuities. And it essentially said the charity looks at the present value of, they presume that they're going to keep about 50% and they work backwards and give you a specific rate. Very simple, very easy to do.
So it's not uncommon, I don't know, maybe 10 times a year or so, I'll get a client that comes to me and says, I want to do a CRT. I need to do a CRT, Jenny, and someone told me to call you to do a CRT. And oftentimes I actually think they're better candidates for a charitable gift annuity versus a CRT. So Helen, do you want to kind of walk through the considerations there?
Absolutely. And I was just talking with Sunny because she asked us to speak to one of her donors about this exact question. He had some real property, it was appreciated, and he was trying to figure out, should he do a CGA or a CRT? They're both split interest trusts in which the remainder interest goes to charity and the first portion during the grantor's lifetime goes to the grantor generally. But there are some differences. A charitable gift annuity might offer a slightly lower rate. It's plug and play, very specific and fixed. You get the number and you get the payment. So it has less flexibility than a charitable remainder trust, which we'll talk about. However, it has some amazing benefits. First, the payments are guaranteed at a fixed rate for the rest of the donor's lifetime. And that's great for someone who is interested in ensuring stability, right? If you create a charitable remainder trust, you can also make annuity payments or income payments, which we'll discuss. But the assets, but if something happens, the market goes down and the charitable remainder trust runs out, you're done. Whereas with the charitable gift annuity, even if the market crashes, the amount that the donor originally put in has been lost, the charity still has an ongoing obligation to pay the donor for the rest of his or her life. So it's this wonderful, conservative, fixed payment. As a part of that, the next piece is that it's simple. And then also there are fixed tax characteristics. So every single year, the donor knows, what portion is going to be ordinary income, what portion is going to be capital gains, and what portion is going to be return of principal. So it's a very simple and effective technique. A charitable remainder trust offers a lot more flexibility. If there are complicated assets, a charitable remainder trust is probably a better tool for flexibility. And a charitable remainder trust allows for more variability in payments. So if the value of the assets goes up, the payments also go up.
Yeah, and I think it's worth it, certainly like as professionals to again, you hear a lot CRT, and I think we wouldn't be doing our clients a service if we didn't go through the charitable gift annuity option with them. I think 9 times out of 10, my clients prefer or not, they like the charitable remainder trust because they actually want to be able to be controlling the investments, and they oftentimes think they can get better rates of return using their own financial advisor. But for conservative clients or clients not working with a financial advisor, the charitable gift annuity is a awesome option as well.
And one other important difference between a CGA and a charitable remainder trust is that when you enter into a CGA with your charity, you are irrevocably giving your assets to that particular charity. Some of our donors, they're fickle and they want to control, have the ability to make changes to their ultimate charitable beneficiary. So a charitable remainder trust, the donor retains the control over the investments and the donor retains the ability to change that final beneficiary, unless they decide otherwise.
So now kind of moving into a deep dive for we'll do one more slide ahead. Yep. A little bit of a deep dive into a charitable remainder trust. So as I mentioned, oftentimes if you want to do cash in a charitable remainder trust, easy, but it's not uncommon for clients to come to us sort of pre-liquidity event and say, I've heard about this charitable remainder trust. I want to do a charitable remainder trust. And I want to get the benefit of the CRT prior to my liquidity event. And this gets to, well, we got to do some work to make sure that the asset you want to transfer to the charitable remainder trust is actually an appropriate asset to transfer to the charitable remainder trust. So charitable remainder trusts are charitable entities, and charitable entities have specific rules about what types of assets can and cannot be transferred to a charitable remainder trust. So what if I have a client that has an operating business, and the client knows that he's about to, or she is about to put that business to market, or they say, I'm about to sell. The first question I always ask is, how far along in the sales process are you? So as we all know, it's not uncommon for our clients to come to us at the last minute and say, the sale is going to close in a week, or I have an LOI. So question for you, Helen, how close to the sale of a business are you comfortable transferring that business to a charity? What's your rule?
My first question is, what's in writing?
Yep.
And unfortunately, if it's real property, what has been agreed upon? Yep. So the rule is that if you have entered into an agreement and the sale is already going to occur under the terms that you've agreed upon, even if it's an oral agreement, particularly for non-real property, the IRS is like, hold on. So, the reason we want to make a donation to a charitable remainder trust of the business is because then we give the appreciated asset to the charitable remainder trust. The charitable remainder trust is a tax exempt entity. So when it sells it, let's say you created a business for, you have a company that's selling for $10 million, you pop it into the CRT. The CRT can sell the business, keep the $10 million, invest it, the full 10 million, and then make payments to you over time where you have to, pay tax on the payments that are sent out. But if you come to us a little bit late and you say, okay, we're about to do this, and I just realized I'm going to pay tax on $10 million, let's do a CRT. Again, our first question is, well, how far are you along in the process? Because the IRS says, listen, if you have already, if the deal's about to go through, then even if you've contributed the asset to the CRT, which is tax exempt, we're treating the structure, the transaction, as if you sold, you pay tax on that. you get an income tax deduction for the donation that you made to the CRT. So it is a significantly less effective giving technique if you have to sell the property and then give cash, because now you've had to pay tax. You have to pay tax. You get an income tax deduction, but you still have to pay tax. So we always like to work with clients as soon as possible to ensure that we don't have this, what we call anticipatory assignment of income.
Yeah, my rule is no LOI. Like if there's an LOI, we're not doing it. I think some people will push it a little bit, but that makes me uncomfortable. Yes.
If the gift was going to a donor advised fund, same situation. If the gift's going to a donor advised fund instead of a CRT, you've got the same concerns about.
So the concept of anticipatory assignment of income is the same regardless of where the asset is contributed.
Good question.
You're absolutely right, depending on the DAF. We've worked with a number of DAFs because we do have relatively unique gifts, concentrated gifts, et cetera. And again, it really depends on the DAF, their rules, and oftentimes your relationship with the institution. But you're absolutely right. There are some that may be more, just as easily given to a DAF as to a CRT. As Jenny mentioned, and as you pointed out, CRTs have many of the tax characteristics of a private foundation. And a private foundation means more strict oversight, more restrictions. So you're absolutely right. The DAF has the characteristics of a public charity, more flexibility, less restrictions, still some restrictions on excess benefit transactions, but less restrictions. So again, when we're looking at an asset, we want to understand the character of that asset. As a quick side note, S corporations should have to be looked at very, 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 very carefully within the context of a CRT. A CRT cannot be a shareholder of S corporation stock, and that's just standard public service announcement. So if anyone says S corporation, be very, very careful.
But Helen and I have worked on a situation where we got around that because an S corp can create a CRT.
Yes.
Which is pretty fun. I want to move ahead to charitable lead annuity trust. So that's slide 23, or charitable lead trust. All right, boop, boop, boop. There you go. Ahead. There we go. Awesome. So charitable lead trust, and it has been and continues to be one of my favorite strategies if the client profile is correct, and if the client, for the right client. But I've have gotten very successful results with charitable lead annuity trusts. Specifically, the type of charitable lead annuity trust that I like is a zeroed out grantor charitable lead annuity trust. But Helen, why don't you go over the basics of a charitable lead annuity trust, and then I'll talk about my favorite.
The magical, we do. It is like the magical estate planning tool. And we do tell our clients, we're like, charitable, even if you're not charitably minded, this is a phenomenal transfer tax tool that Jenny will talk about. But generally, as we mentioned, when you have a split interest trust, a portion of the assets goes to non-charitable beneficiaries, and a portion of the assets is separated for charitable beneficiaries. So with charitable remainder trust, charitable gift annuities, what happens is the donor or the non-charitable beneficiary gets the first half and the charity gets the remainder. A charitable lead trust switches that. So the charity gets the first series of payments at the end of the term. The donor or the donor's recipients, named beneficiaries, are able to receive the assets with no transfer tax.
So we'll go to the next slide. There's many different, just like there's many different types of CRTs, there's many different types of CLTs. The CLT that I was getting excited about is a grantor CLT. So meaning it's a grantor trust. So the grantor is responsible for the income tax payments associated with the assets inside the charitable lead trust. Essentially, if I have a client who is looking to generate an income tax deduction for the year and is also motivated to get assets to their children, or to trust for the benefit of their children, a grantor charitable lead annuity trust is a really great option. So the client would transfer assets to the charitable lead annuity trust, and the client will get an income tax deduction associated with the assets transferred to the charitable lead annuity trust. Then, as Helen mentioned, payments have to go to a charity for the term of the charitable lead annuity trust, a 10-year term, a 20-year term. The payments are fixed at the beginning of the term, and the payments are fixed based upon the 75/20 rate, which, as we know, is pretty high right now. I think it's like at 5% this month.
Relatively high.
Relatively high, correct, relatively high. But you can do a look back for a couple months prior. And so essentially, if the assets that you transfer to the charitable lead annuity trust, if they exceed the hurdle rate over the term of that trust, whatever's left in the trust at the end of the term will go to the grantor's children free of transfer tax. We have some clients that will do annual charitable lead annuity trust. So basically, this is the most wonderful time of the year. And it also means that we are scrambling for our clients to figure out ways to get income tax deductions. And so we have some clients who at this time of year come to us and let us know the amount of an income tax burden that they're going to have for the year. And we put together an annual charitable lead annuity trust for them so that we can generate the income tax deduction. The type of charitable lead annuity trust I was referring to is a zeroed out grantor charitable lead annuity trust. The transfer into that trust not only generates a income tax deduction, but it also has no estate or gift tax implications. And so if the strategy fails from the perspective of the investments don't beat the IRS hurdle rate, they still get the charitable deduction. They haven't lost any of their estate and gift tax exemption, but nothing goes to their kids. But as long as you awesome financial planners in the room and financial advisors are able to beat the hurdle rate over the term of the charitable lead annuity trust, it's a really win-win, both for the client as well as for the client's children. One important thing to note about that transaction is it is a grantor trust. And so we have created a vehicle that also we need to manage the income. We also need to manage the income within that vehicle because the grantor is responsible about it. So it's like you solve a problem for year one, but then you create a problem for year two. And so just being cognizant of that is important. One thing that we've been successful with our clients is actually wrapping the assets in a charitable lead annuity trust into private placement life insurance. So we kind of continue to get that tax-free growth, but we're not creating an additional income tax burden for the grantor.
Charitable lead annuity trusts are interesting in that I think a lot of they're different than the standard charitable remainder trust. Go ahead. Absolutely. Those are good questions. The question was about backloading or shark fin CLATs, which we'll describe to you right now. So when I think of a charitable lead annuity trust, it's a complicated tool, and I think folks feel less comfortable with it because it is significantly different than a standard charitable remainder trust. But particularly when interest rates were low, it was a phenomenal planning opportunity because, as Jenny mentioned, you have this hurdle rate, which is maybe 2% or 3.4%. And as long as you pass that or exceed that, then you get more to your family. But then and I sort of think of it as a GRAT with a charitable component, right? That sometimes helps folks like sort of make that analogy. As long as you pass that hurdle rate, you get more to your kids. But unlike a GRAT, a charitable lead annuity trust allows you to vary the payments. And the IRS says, they actually say you can vary the payments, period. They don't give a percentage. So what you do is, what we do is we say, okay, well, we have to give payments to charity, right? And let's say we're giving 10%, it's 10% a year just because I am terrible at math. So then over a 10-year period, I know what that number is, $100,000. And so when you create a CLAT, the standard is, okay, well, you give, 10% and it's from the beginning to the end, done.
$1 million CLAT.
Thank you.
You do $1 million CLAT. And so, and it's for 10 years. So you need to do $100,000 each year.
Exactly. Thank you. See, it's the zeros that get me. So if you don't pass the idea is that you're going to pass that hurdle rate. But then the other thing we do is we say, instead of giving $100,000 a year, you can actually build in varying annuity payments. So you can vary the payments and say they're going to increase 20% a year, they're going to increase 40% a year. With a shark fin CLAT, you say, well, they're going to, increase, whatever the amount is. So that way it's like, 70% a year. So that way at the very end, you're back ending the payments to charity. And that means you have more assets in the beginning to build up your investment portfolio. Because what happens is at the beginning of the term, you say, I'm going to, increase by 40% each year. There are actual rules, and the calculation is based on, the 75-20 rate. We're going to give $25 in year one, $65 in year two, $100 in year three, et cetera, and then, like $900,000 in year, 10 or 20. And so you have what looks like a shark fin. And there's been a lot of commentary because the IRS has been silent on how much you can vary the annuity payments. So what we normally say as well, so you have a wider variable than GRATs. You can vary GRATs, excuse me. So you have a possibly wider variation on what you can use for the increase in annuity payments. To answer your question, I do not counsel my clients to enter into shark fin CLATs, which is the most aggressive tool. We have gone up. I mean, I have not gone over 50%. I prefer 20% because that's like, the standard rule. But you can do that. And when you have the payments on the back end, that allows you to have more assets on the front end to increase and hopefully get more assets to your kids.
Yeah, from my perspective, I'm comfortable with increasing annuity payments. I think the shark fin to me feels like, what do they say? Like pigs get fat, hogs get slaughtered. Like the IRS hasn't said you can't do it yet, but it just seems like a little too pushy. If client really wanted to do it, I would, but you can get such great results without taking that extra step of aggressiveness. And again, I think most clients who are doing these structures in the first place, like are charitably inclined, and I've found aren't kind of comfortable with that extra risk. We are almost out of time, but I think in like our last 2 minutes, can you talk? I think we got to talk about the Secure Act.
Yeah. So the Secure Act, as you know, has significantly impacted planning for retirement assets. And it's still right now, I think folks are still needing an education on, how the rules have changed, how this impacts them. Again, because we've had it all our lives, the rule that you want to save as much as you can in retirement assets and pass it on to your kids so they can save as much as they can. That has really changed in a couple of ways. As you all know, the rule is that unless other than for a beneficiary spouse, unless there are certain extenuating circumstances, IRAs must be distributed within 10 years. So it can either be a 10% amount each year on a pro rata basis, or it can just be, you increase all of it and then you pay tax at the very end on the whole amount at 10 years. So there's a couple of issues that we talk with our clients about. And the first is, maybe folks want to give to charity, but they also want to give to their kids with a steady flow of income. Instead of having IRA assets go into a lifetime trust, which we used to have as a conduit or maybe accumulation, that is not going to provide as much benefit because you have a 10-year payment. And so what we work with our clients to do is come up with other ways to support their charity and to support their beneficiaries, either through a charitable gift annuity, where they actually name an organization as a beneficiary of their IRA with language stating that charitable gift annuity will be created. In those situations, it's very important to work directly with the charity beforehand, if possible. It's not necessary, but there are some tricky rules when it comes to charitable gift annuities named as an IRA beneficiary. You can also use a charitable remainder trust, and a charitable remainder trust is where you, instead of naming your kids or a trust as an IRA beneficiary, you actually name a charitable remainder trust. Because a CRT is a tax exempt organization, the payments from the IRA, let's say $1 million goes to the CRT, also $1 million, no tax due. The CRT can then continue to invest those assets, but instead of distributing them over just a 10-year period, they can distribute them over the lifetime of the beneficiary. So there are some great tools for someone who is both charitably minded and wants to ensure ongoing stream of payments to their kids.
So I think we're at 9:01. Thank you, everyone. Helen and I are available for questions afterwards, and we appreciate your time.
Thank you.
Happy holidays.
Thank you. Hey, thank you so much, Jenny and Helen. Great job. Whirlwind tour through the charitable world and the myriad issues in planning for income tax deductions, estate gift tax avoidance, and everything in between. Well, certainly our January 3rd meeting is with Mark Morris over here on some exotic estate planning that we'll be addressing. And other than that, thanks for coming and have a great holiday season.